Hey everybody, it's Mike from Taxes and Bricks. Well, it is Friday, so we're going to do a little modified mailbag here. So welcome to episode 20, where we're going to talk today about the difference between marginal and effective tax. I know, ooh, exciting, but no, stay tuned because I'm going to talk to you about what those two terms mean. I'm going to talk to you a little bit about why it's important to know the difference between the two. And I'm also going to talk to you about how knowing the difference between marginal and effective tax could potentially prevent a crime from happening. And so I say it's modified mailbag because this isn't in direct response to a question that I got like the other mailbag or two that I've done. This is actually sort of inspired by a question that I got about marginal and effective tax that sort of didn't really ask me what they meant, but sort of skirted around the issue. And then also another instance where just prior to Christmas, I had a client who found themselves in a situation where had he not called me, he would have jammed a pencil into his boss's eye, and that would have been bad. So, yeah, knowing the difference between marginal and effective tax could prevent a crime someday. You never know. It did, I guess, with me. So great. But first, if you like this kind of content, go ahead and hit the like button below. Definitely leave a comment. I reply to all of them and I read all of them. And so thanks. Keep those coming. Definitely subscribe and share our channel and our content with your friends. We're going to pay the lawyers here really quickly. Since this is going to be sort of tax related, I want to throw up a little disclaimer. So we'll pay the lawyers and we'll be right back after this disclaimer.
This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you.
Welcome back. Thanks for hanging in there for that disclaimer. So a couple things before we start. I want to start with a definition of effective tax and a definition of marginal tax. But I'm not giving you the textbook definitions because they're written by old, boring accounting professors, and they're old and boring, and I'm neither of those things. So there's no way that I'm using the textbook definitions here. I'm going to give you a correct definition, but I'm going to give you a correct definition you can use, okay? I mean, there's nothing worse in accounting. They like to define words using the words. Like, your effective tax is your effective tax on all your income. What the heck does that mean? No, your marginal tax is your marginal tax. It's not, no. I'm going to give you a usable definition. But I also want to tell you, too, that a good bit of this video is going to be me with the camera turned around on my computer screen. So you guys can kind of see some numerical examples of what I mean here. And also, I'm going to walk you through that story about that client prior to Christmas and kind of show you what happened with him and how I talked him out of pushing his boss off a roof. Let's start with the definition of effective tax. I define effective tax as the average tax that you pay based on your income. So give you a really quick, numerical example. Let's say your taxable income is $100,000, okay? And you end up paying $12,000 in tax. Your effective tax rate was 12%. That's 12,000 out of 100. Pretty easy. Marginal tax actually has to do more with where that $100,000 falls in the various tax rate schedules. I'm going to throw up the 2021 tax rate schedules here in a second as we talk about Steve and his situation, okay? So effective tax is the average that you pay based on your income. So 100,000, you end up paying 12, you paid 12% effective tax. Woohoo! Okay? Marginal is actually where that 100,000 falls in the different brackets, because you could be in a higher bracket than 12%. In fact, most people end up being in a higher tax bracket than their effective tax works out to be. And I'm going to show you why in a second, okay? So those are the definitions there in terms of marginal versus effective. I'm also going to give you guys the question that kind of spurned all of this. And I'm going to give that to you in just a second here as I sort of turn the camera around. I do want to say, though, because this is a mailbag and because of what I do, I have changed the names and a good bit of the details to protect the innocent here, and obviously protect people's privacy and whatnot, because duh. But the salient details and the point of this whole thing, for educational purposes, is essentially there. And it illustrates the same point that I would have illustrated if I was using actual names and facts, which are totally unimportant to this video. So sit tight. I'm going to flip the camera around here and we're going to talk. You won't see me. I know, sad. Try not to be too disappointed, but you will see the computer screen here in just a second, and we'll start running through. I'll tell the story about Steve. I'll give you that question and we'll go from there. All right, well, before we talk about my good friend Steve here and how we prevented him from committing some kind of horrid crime against his boss, I want to talk a little bit, now that we've got the tax rate schedules, or the quick tax method that I have here that I use, up on the screen. So we talked about that example where somebody makes $100,000, and let's say it's a married couple, right? So they're above $81,051, and they're below $172,750. So they're pretty solidly in the 22% bracket, but they don't pay $22,000 in tax. Why? Because if you just stop here at the formula and you multiply by 22%, you're going to come up with $22,000, and that's wrong. $100,000 multiplied by 22% is $22,000 for sure, but you're allowed to subtract $8,503, and that gives you a tax of $13,497. So marginally 22%, but effective is more like 13.5%, because I take the $13,497 that they pay in tax, I divide it by the original $100,000, and I come up with 13.497%, or 13.5% if you want to be round and clean, okay? And that is kind of a really quick version of marginal versus effective. $22,000 would be marginal, but that's not what they pay. They pay $13,497, okay. Guy by the name of Steve calls me up a couple weeks before Christmas. I've known Steve for a long time. Well, actually, not really a long time, but long enough, okay? Calls me up, and he tells me that his boss just walked into his office, and he is fuming. Not his boss. Steve is fuming. Steve was using swear words that would make a sailor blush. I mean, I've been known to walk into a bar and have bikers and truckers come out crying after I open my mouth. However, Steve was saying things that made me uncomfortable. And so Steve was really, really PO'd because his boss just came in and told him he was getting a huge bonus. Huge bonus that was more than what he usually gets. So let's run down Steve's normal situation. This is what he and Mary go through normally before he was notified by his horrible boss that he's going to be getting this, bonus. So Steve and Mary, taxpayer. Mary's an executive. She makes $175,000 after 401k. Steve makes $150, $150 after 401k. That includes his normal $10,000 annual bonus that he pretty much just gets for, breathing and showing up on time. Okay. Steve also has an inherited IRA that he got from a relative who died and left him an IRA, and this was a long time ago, and Steve annually just has to take $30,000 out of that. I know, terrible. Okay, so Steve and Mary doing pretty good. $355,000 adjusted gross income. That's $175, $150, and $30. They have $42,000 in itemized deductions. That's $10,000 in SALT. If you're not sure where that comes from, go back and watch the SALT video. We've got $20,000 in mortgage interest. There's also a mortgage interest video you can watch, and a charitable contribution video you can watch. That's how they're allowed to take $42,000 off this $355 to come to a taxable income of $313,000. Their marginal tax bracket is 24%. Look over here. See? Married couple, filing jointly. Okay? Their income is above $172,751, but below $329,850. $350 or $313,000. Okay? So 24%. We multiply 24% by $313,000, and then we subtract $11,958. We come to $63,162. If I take $63,162, which is the amount of tax that they pay, and I divide it by $313,000, I get an effective tax rate of 20.1%. That's important, because what happened here was Steve didn't call me first. He consulted the internet, which, I'm sorry to say, Steve, if you're not looking at cute videos of kittens or, the escapades of celebrities on, I don't know, Instagram or something, you're totally misusing the internet. After Steve stupidly consults the internet instead of calling me, here's what he comes up with on his own. Mary, 175 after 401k. Steve now at 170,000 after his 401k. That includes his new $30,000 bonus, which used to be 10,000, so he's got an extra 20. Inherited IRA is still 30,000. His AGI is now 375. Okay, now he's starting to sweat a little bit. His deductions are still the same, 42,000. Now his taxable income is $333,000 instead of 313. 20 grand more, because that's the only difference between this scenario and what he used to have, the $20,000 more in his bonus. So where is he now? He's above 329,851 by just a couple of dollars. Still below 418,850, but he's there in the 32% bracket. But here's where Steve went wrong. Either he consulted some crazy site on the internet, I don't know what he did, but he assumed that with an effective marginal tax rate of 32%, he was going to be paying a tax of $106,560. That's 32% of $333,000. With an effective tax rate of 32%. No. Now, Steve at this point is starting to get really upset, and his blood pressure is rising. Because here is what he thought. Okay? Steve thought at 24% on $313,000 that they pay $75,120 in tax. No, we already said on $313 he pays $63,162, so he's already wrong off the bat. Steve then runs the numbers that he found on, I don't know, wrongtaxnumbers.com, and he figures the extra $20,000 in bonus, which pushes him into the 32% bracket, is going to increase his tax from $75,120 to $106,560, which is $31,440. So he now has figured out on his own that a $20,000 bonus costs him $31,440 in tax. I don't know what crazy universe you live in, but that's not correct, Steve. And let's show you why, okay? And this is what I told Steve, which then talked him off the ledge, and we were able to get it so that he didn't follow his boss to the parking lot and pummel him with his briefcase. Steve and Mary taxpayer, here's the real deal now. Mary, 175, she hasn't changed. Rock solid there, Mary. Woo! Steve, 170, $30,000 bonus. Steve's inherited IRA, 30, adjusted gross income, 375, itemized deductions, 42,000, taxable income, 333, so all the same. Marginal tax bracket, 32, with me. Tax, 68,214. Not 106 grand, Steve-o. Effective tax, 20.4%. That's 68,214 divided by $333,000. The $20,000 bonus, yes, increased his tax by $5,052 and not $31,000. And their effective tax only went up by 0.3%. Okay? So, Steve got talked off the ledge. He was fine. He actually went in and thanked his boss and had a lovely Christmas, and then thanked me with a lovely bottle of wine. Truth be told, I think he should have bought me a Porsche because he got to keep his job. But, you know, listen, Steve, if you're out there, I take my Porsche in a medium, something more in like a hunter green, but, you know, whatever. Either way. There was another question I got that sort of spawned this kind of thing here, and it had to do with the fact that I had a client who was basically under the impression that they were supposed to withhold at their job based on whatever tax bracket they were in. So I don't know if their boss or some coworker was like, look, you and your wife are married and you make, $100,000. You need to be withholding 22%. And so they did. And they were actually a new client. And I had to set them straight because $22,000 for a married couple making $100 grand combined. I mean, $100 grand is nice living, but that's way too much money. And so, okay, they got a $13,000 refund coming to them. And I guess that's nice, but at the same time, $100,000. They've got housing costs. They've got food. Maybe they want to take a couple of vacations, buy themselves a couple of nice things during the year. You work hard for your money. You don't want to let the government sit on it. And it has nothing to do with the government, giving the government an interest-free loan. That is not what this whole thing is about. Knowing your effective tax is not about, you're giving the government $13,000 and they're not paying you interest. Because realistically, 99% of the people I encounter who say that they're going to take that money instead of giving it to the government and then getting it back as a refund and put it in the stock market or put it in a bank account and gain interest, aren't going to do that. It's just going to get absorbed into your normal monthly budget. But the point is, for a married couple or even a single person who's maybe at a lesser income, not $375,000 like Steve and Mary, maybe at 100 or less, or they have high overhead, that could mean the difference between comfort and discomfort every month. It could mean the difference between coasting into the end of the month with money to spare and not. It could mean the difference between having an opportunity to put money away for retirement and really improve your future rather than letting the government keep it, because it doesn't have anything to do with the government not paying you interest or paying you interest on your refund. It really has to do, for some couples, with comfort. Okay? So it's really important to understand marginal versus effective. I think that that's really, really important. If for no other reason than you don't end up creating a voodoo doll of your boss and then burning it in the trash can in your corner office. All right, thanks for watching. Hope you enjoyed today's video about marginal and effective tax, and I hope that you do not end up like Steve. Or if you do, that you call an accountant before you run your boss over with an SUV. Stay tuned Monday. We're back Monday, back on taxes. We're going to do a sort of a 4-part series on filing status. Since it's tax season, I thought it was important to kind of run through filing status. We're going to talk about why it's not okay to tell the government or someone you meet in a bar that you're single when in fact you're legally married. We're going to talk about what head of household really means and what it doesn't mean. We're going to talk about single and married filing separate, and qualified widow and qualified widower, and what those mean as well. So stay tuned. Monday starts the 4-part series, and we'll do the next one on Wednesday and then probably finish it up the following week. Definitely if you like this kind of content, leave a comment, subscribe, share our channel and content with your friends. Thank you for watching, and have a wonderful, wonderful weekend.